Hello and welcome to Power Charting. My name is Bruce Fraser and I'm your host today with the professor, Professor Roman Bogomazov. Welcome, Roman.
Hello, Bruce. Hello, everyone. Good to be here.
We are in episode 6, and this was recorded on September 6th for airing on September 7th. We have a very special episode for you today because we are going to change things up a little bit and talk about distribution. And we've had some interesting conditions and situations unfold in the market, and we want to sort of turn our attention to these concepts. But first, we have an announcement. And we have an offer every Wednesday, 3 to 4:30 Pacific time. We conduct a Wyckoff market discussion. And this market discussion is for Wycoffians that are interested in studying the current conditions of financial markets with an eye towards developing their mastery skills in Wyckoff, the Wyckoff method. We talk about markets, we talk about individual stocks, commodities, interest rates, whatever is most appropriate for that particular week. And we have a very special offer for you, which is a 3 sessions for $30 rate so that you can become familiar with what we do and how we do it, because we think you're really going to like this wonderful time that we all spend together talking about one of our favorite subjects. Roman, what do you think?
Well, I just would like to welcome everybody just to come to our community, experience this. This is a very inexpensive way to do so. So come sign up for these 3 sessions. Check out, what we do during those WMD classes.
And we don't do this offer very often. Probably it'll be sometime next year before we offer the 3 for 30 again, if at all. And so please come join us. All right, so let's get to work. So today we're going to change our focus. This is actually a technical scan that is from the bearish side of the predefined scan results. And this is stocks that have moved below their lower Keltner channel. We are going to focus on the New York and the NASDAQ both and take interesting candidates from each area. And to discuss the idea of the Keltner channel, Keltner is based on a 20-day or a 20-period EMA. And unlike the Bollinger, it's a little smoother and has a little bit more of a consistent envelope around the 20-period EMA. It's calculated based on average true range, with the 2 average true ranges above, 2 average true ranges below the moving average, which creates this envelope. And then you can see from this particular example, what we're scanning on is the stock or the instrument falling below the lower Keltner channel line and breaking down through that. And you can see this happens periodically in the course of a downtrend. So Roman, any thoughts?
Yeah, it's just when we go up, we're going to have conditions when the price actually overcomes the channel. And this is the environment that we're going to experience in the uptrend or on all of the extremes of the upswings. And then to the downside, we have the same environment, only reversed. And that's basically what we're looking for. So whenever we're going to use this particular scan, we have to think that after this scan results come to us and we look at all of the stocks, they're most likely right before some kind of rally. If we're talking about the oversold position on Keltner. Bruce?
The other thing that we want to talk about here is the distribution schematic that we use as a framework for analysis in Wyckoff. And so we're going to take a couple minutes and talk about this because our examples today are going to fit the distribution paradigm. And here you can see that an uptrend forms and becomes overheated and produces two conditions of climactic behavior, which is preliminary supply and the buying climax. We know that large interests, the CO types, composite operator, come in when we get an automatic reaction. And an automatic reaction is a very large reaction in an uptrend that is much greater than any of the reactions that preceded it on the way up. This sets the condition for a trading range. So we have resistance at the high of the buying climax and then support at the low of the automatic reaction. And thereafter, we have a series of range-bound rallies and reactions that are either going to produce a reaccumulation for another move up or a distribution for a move down. And so in this particular case today, we're going to talk about the distribution phenomenon. And so we're going to look at examples of that. And as you can see from this schematic, that where the Keltner channel might be penetrated on the lower bounds of the envelope. And Roman is circling these right now. And so this condition shows the potential to be able to participate in the completion of distribution for those that are interested in following weakness down, using this distribution schematic to sort of frame the conditions for the conclusion of distribution and the beginning of markdown. And so Roman, bring us home on this.
Yeah, so we are going to look today at the stocks that are in a different structural spot for their distribution, but Keltner channel, or rather the price moving below the lower Keltner channel, is showing to us that short-term these stocks are oversold, but they are in the distribution type of pattern. So we're going to look at one stock that is going to be close to the upthrust. Another one is going to be the stock that is close to the sign of weakness and last point of supply. And then the last one is going to be on the way down in the downtrend channel. Bruce?
Well, let's have a look. So here we have a semiconductor stock, semiconductor equipment name, KLA-10 core, and notice how you have after a run-up, you have a climactic surge that occurs into late January. So there's preliminary supply there, and then there's the climax, and then following the climax is the automatic reaction. We really want to develop our skills at being able to see this because this is an important change of character in the chart. Following that, there's another rally up that takes us into an upthrust action, which occurs early in the what appears to be the distribution process. You can see here that we're not out of this range-bound area. And so notice that with the automatic reaction, we have a change of character. We have a very sharp rally, which tends to make people bullish. But notice the reaction that comes after that. The reaction that follows is a very sharp decline, persistent, has a very big range. It's equally as strong in its decline as the decline from the buying climax to the automatic reaction. Roman?
Yeah, the thing that catches my eye here is more to the right. This last attempt to upthrust to overcome the previous resistance levels on a very, very high volume signature. So that suggests that the effort to the upside is increasing, and the buyers are trying to push the price through 120, 122 level, and yet they fail. And that's what creates this supply tail on this big spread, and this is probably on news announcements. So after the multiple attempts to go up on the rally, secondary test rally, on the rally after that, and the upthrust rally also fails. Multiple tests are following this attempt to upthrust, and both of them are failing as well on somewhat diminishing volume signature. And they are failing right on the level of the resistance that was created by the buying climax, so which is structurally a weakness at this spot. And obviously, Bruce, this big bar tells us a lot about the bias that is so visible right now, and that is to the downside.
Testing is such an important part of distribution, and notice how there's this attempt to go down after that upthrust that Roman was just talking about, that attempt to go up, and then there's a break into the gap area, and then another attempt to rally. Well, we would pay very close attention to the quality of the rally, and we can see there that the volume dries up as prices go up, which shows that there's a lack of good sponsorship as we get further and further into this formation. And then an attempt to test the prior peak, which makes a lower high. And then from that, there's a response to that test, which is that gigantic bar. And so this is very interesting. Probably there could be an attempt to stabilize in here, but we're going to be very acutely paying attention to how KLAC gets down to the support line below, the speed with which it goes down there, and then its ability to rally. Very low quality rally would tell us a lot about the future direction and trading tone for KLAC. Roman, should we move on to the next one?
Yes.
Why don't you start with Varian?
Well, a very defined climactic run in January of 2018 with gap, increased velocity, momentum to the upside, a huge true range for the gap day, obviously on some news. And then the next day, spread is diminishing, the volume signature is still high, so that suggests presence of the supply. And off we go into a large reaction, which is a change of character reaction for us that suggests a change of environment from uptrend to consolidating environment and suggesting a trading range to develop. So a climactic action, automatic rally, secondary test follows and concludes phase A, so that stops the uptrend from moving further up. And then we have a lot of volatility in phase B, especially here in the middle of the range. And that's a very interesting spot to me, Bruce, because that kind of shows that whatever selling has happened in phase A, it's actually was not just to stop the price from moving up, but actually it was distributional in quality. And this shakeout in phase B suggests that this is just a continuation of that distribution. And then the next attempt for institutions to come in and actively sell the position is going to be here on the attempt to upthrust, and actually there is a local upthrust here, so we would probably define this as phase C. And now currently look at all of the rallies. They're so weak, they're coming to the points of the resistance, and then the price fails again. So looks to me, Bruce, like a very structurally weak stock.
This is really interesting because we see the rallies in each case are diminishing in quality and extent as we go further and further through, which shows that there's active sellers over the market in each one of these attempts to advance. So the other thing that stands out to me is how much weaker Varian is from the broad market indexes. So we see the lower highs being made throughout, while the NASDAQ and the S&P continue to make good lows and then higher highs as we went from the spring into the fall. And so the relative strength characteristics of Varian is really not very good. But these attempts to rally, especially this last one, the thing that I would notice on this last attempt to rally in late, starting at the end of June, is that this is a big sign of weakness. And so we have an important sign of weakness right there. And then an attempt to rally, which upthrusts the prior peak. The rule that we use for point and figure counting is that we look for a sign of weakness, and then we will watch the rally that comes after that, which produces an LPSY. And then we count from the LPSY from right to left across, and then we can segment those counts. But then this is the condition that tells us that we're very close to the end of the distribution and beginning the markdown. And so the sign of weakness, which takes out the May low, and then the rally into an upthrust and an LPSY, tells us that this is the last good attempt to rally before we are down and out of the the distribution area. And look at how it just slices right through that support area, which is a huge tell about how weak this stock really is. So this is a very interesting case study. So Rahman?
Yeah, a couple of other points here. Again, coming back to the price moving below Keltner lower channel. We see it here. We see it here. And now again, we see how the price, closes below that channel. So all of these spots are actually located in either late phase B or phase D. So, and this is where we will see more and more of a structural weakness after initial distribution. Another thought that I had here is there are quite a few questions from students that come, and the question sounds like this. When I look at the volume signature and going into a possible sprint situation, or maybe a possible last point of support, so this is where the students are thinking that the bias is going to be to the upside, just based on decreasing volume signature and how the price maybe reluctantly just go below certain support levels. In a lot of distributional cases, you're going to see that diminishing volume signature into phase B. And then your next clue about a distributional nature of the structure is going to be probably on the action like this, on this upthrust attempt, where there is a lot of effort to push the price up, and yet result is diminishing. And it shows that there is no ability for the buyers to push the price above previous levels of the resistance. And that's what we're looking for. In some instances, distribution is going to be more seen on the right rather than on the left. So sometimes you just have to wait and to see the volatility to increase. And that would give you a really good clue on the distribution.
Just a brief comment on the concept of ICE. So the low that was made at the end of June, beginning of July, is an attempt to go down. You can see there's a pretty sharp break, and then it rallies in two stages, and there's a higher low there in mid-July. So we see the higher low. So we can almost draw a line from the low at the end of June through the higher low, and then you see that there's this like wickedly sharp break of that area right there, and then an attempt to rally. See that attempt to rally at the end of July, early August? Well, that is a break of the upper ice, because you can see this comes on volume, it has wide spread, it breaks hard, and then it goes down to the support line, attempts to hold there, and then has a very brief rally attempt with no follow through. Well, that is an attempt to rally up into the upper ice. And when it fails there, this is a very important clue to us, because then there's this sharp break below support. That is the break of the lower ice. So usually ice comes in two places. So you look for how violently it breaks down at a level and say, this looks like the breaking of ice, especially if you've already had a big sign of weakness that preceded it. And then you have another one that takes it down and out, and look at the inability of the Varian to be able to rally back up through old support, which is now new resistance. So that tells us the poor quality of that rally into this lower ice also tells us that Varian is very compromised at that level. And sure enough, it starts to turn away from that. This is a very vulnerable place for this stock. Okay, so Ramon, how are we doing? Let's go to the next one. This is a real interesting case study, international game technology, and it has a very pronounced climactic run. And prior to that is a preliminary supply, may come into play later. And then notice this is a sort of a very common occurrence. So we have a bind climax automatic reaction that sets the resistance and the support. And we would expect trading to occur around the bounds and within the bounds of these two areas for the foreseeable future. Well, this is actually going back to November of last year. And this trading range has really been in play right up into the end of July. So we can see that after the automatic reaction, there's an attempt to rally, and it throws over the resistance area for very, very briefly, and then notice the change of character. It turns back down on expanding volume and retraces the gains that it made in just a few short periods, about 6 trading days. And look how long it took to get from the automatic reaction up to the secondary test. And so this is a real sign that there's active, aggressive sellers of IGT so far after the buying climax is put in. And then there's another attempt to rally, and this attempt to rally goes up and throws over the resistance area into an upthrust. And this upthrust is again retraced very quickly with a high consistent level of volume. With the important thing to notice, as in the prior decline, is look at the volatility and the wide ranging bars and the persistent decline as it goes from the upthrust down to the support area. This is a really important clue about the aggressiveness with which the CO types are liquidating the stock. Ramon?
Okay, well, let's just finish the structural analysis here. So the next rally brings us to the new high, which is also upthrusting a little bit. So this is a temporary commitment above the previous level of the resistance, and then almost instant come back into the trading range. So the definition of the upthrust. And just looking at the chart and understanding that we're already in the downtrend right here with the lower highs and lower lows, we understand that the last upthrust in the structure is going to be upthrust after distribution. The logic here is that distribution has happened already, and smart hands actually provided the market with the supply that they had. So we have two types of upthrust. One type of upthrust in the distribution in phase B, and then the latest upthrust of the distribution in phase C. And because this is phase C, this is the last attempt to retest the highs that were created in phases A and B. And from here, we're going to have a significant change of character. We're going to start behaving in such a different way where the reactions are going to be outpacing everything what we've had to the downside in the trading range. And then the rallies are going to be very dismal and very weak, and they're going to be the smallest rally then in the trading range. and those rallies are going to be the last point of support rallies. Bruce?
I see two things here that are really interesting, and I love your comment on this, Ramon, is on the upthrust after distribution, there's a sort of an acceleration above the resistance area of the bars. Each of these bars has a tail except for the top. Well, yeah, they all sort of have a tail. And so that shows that there's sellers that are coming in and in the course of the day and selling stock and putting it off its peak. And then there's a tight little range day at the top, and then a couple of days of testing. So there's an attempt to test the highs, and usually with an upthrust after distribution, you get some testing action. But the thing that I find most interesting is after the testing, there's a big wide down bar and then a gap. And the day after the gap goes all the way down into the middle of the range, attempts to close near the highs, but which is at the resistance area. But this is a very bearish bar. Those two bars are very bearish with that gap in there. Ramon, what are your thoughts on this? Because I'm looking at this and I'm going, okay, how do we, this is a really a good short sale candidate for people that are interested in selling short. How do they identify this short sale candidate in and around that area?
Well, definitely it has a lot of conditions that came before this for the price to act in this way, because the price acts very freely to the downside on a lot of increase of the effort. But distribution has started much earlier. It actually has started here with the buying climax. We see this from the volume signature that is expanding with the stop in action that we have here with the diminishing spread. So this is the first time when smart hands started getting rid of their supply. Then we're identifying, maybe localized areas of where supply has occurred again. And look how similar it is to the price range of where the shares of the stock are being sold. So every time the price comes to the resistance, there is a selling. And for the first time, we see the synchronicity between the effort to the downside, between the increase in the effort and the increase result to the downside. So that tells us that this is the timing, this is a potential phase C, and from now on, we're going to be in the downtrend. Another interesting point here is the rallies. I think these two rallies right here are so telling, not just by the size of it, that they are the smallest in the trading range, but also where they come in as their destination point. Slightly in the trading range, and then the second rally that has somewhat of the attempt to increase the effort to the upside. It actually comes right to the point of the resistance here and fails off that. And it fails, again, right on the big bar with the increased volume signature, which tells us that sellers are coming back, and we're probably going to have a continuation. And hopefully, Bruce, this is a really good example of quite a lot of stocks that we see today in the marketplace.
Oh, this is such a great case study, because notice how the volatility increases. We're kind of running out of time here, but the volatility is increasing throughout. And that is the big difference between accumulation and distribution. Distribution is the composite operator types removing their support for the stock, distributing their shares, getting out, which in and of itself increases the volatility through the course of the range. And so when we see that happening, I must say we are at the end of our presentation. Thank you, Ramon.
Thank you.
We'll see you next week.